Hello, everybody. It's Kevin Bullock here, President and CEO of Anaconda Mining, a company that's active in the east coast of Canada. We have limited gold production in our Newfoundland assets in eastern Canada, and we also have a development project which is really becoming the value of our company for the future in Nova Scotia called Goldboro. I'm happy to be here to update people on the progress that we're making.
Hey, good to see you. I haven't seen you since June.
Good to see you, Matt.
Yeah, I see you back in the office and you're wearing suits again. It must be getting serious.
You know, it's getting a lot better here in Toronto. The streets are getting busier, and pedestrian-wise and traffic-wise. So people are getting back. Things are getting back to norm, or the new norm, I should say. And I always think it's good to be interactive face-to-face as much as we can. That's where ideas and strategy pops up better.
Yeah, that's good. Okay. Well, make contact because I've been reading through the press releases since we last spoke about some of the things that you're up to. I think the big topic that I want to discuss is around the feasibility study. You said you put out a feasibility study, okay, which is great, but you're now talking the language of a phased feasibility study. What does that mean? And why? Yeah,
so we, as a lot of people that have seen these shows in the past, which are excellent, by the way, to keep people up to date, what they've seen is a preliminary economic assessment on Goldboro. And a preliminary economic assessment, just by definition, you can include all categories of resource, measured, indicated, and inferred. So you're really giving a snapshot or a projection in time over what can happen to a project with all the resources should they come to fruition. And that's what the PEA showed with some very good numbers, cost numbers and low CapEx and a very robust project. When you move into feasibility and you're defining the project with more detailed engineering and understanding how to go forward, and you're setting up that actual feasibility study to raise project finance, whatever that may be, debt or equity or otherwise, you cannot use inferred because they aren't yet proven. They aren't drilled tight enough spacing to be proven. So you're only allowed to use measured and indicated. A mine life of 8 years plus is usually what's required to go for project finance. And we know we have well over 10 years of open pit mining. I mean, this will be an open pit mine to start with for several years before we even think about underground as the PEA envisages. It's year 5 or 6 that we start developing it. So we chose, instead of raising $30 or $40 million now at a low stock price and dilutive, we are not, to drill something off that won't come into play till year 6 or 7 of production, which means 8 years from now. We would rather do that drilling with cash flow. We have a 10-year plus open pit mine life. So to get that going and not to dilute our existing and future shareholders until this gets started and generates great cash flow from a high-grade open pit mine, whereby we can drill off the inferred and do the phase 2 feasibility, which will be introducing the underground mine to the overall process. And that's how so we are doing the phase 1, the open pit portion of the PEA and a feasibility. Phase 2 will be adding the underground portion. And it's not that we need to start both at the same time and we're delayed with the underground. The underground does not start till we're further down mining the open pit. The other advantage of this, Matt, which is really important, is we will open up the deposit to 3 or 4 years of open pit mining and understand it from in 3D in an open pit, really understand the deposit rather than designing an underground mine based on drill holes that are about that big.
Okay, so I want to be really clear here because I've seen companies make similar statements in the past and they've been absolutely hammered, okay? So the PEA came out with one set of numbers. You're just basically saying, look, I'm telling you now, We've got a two-phase approach to this. You said they were chosen. We've chosen to do this because you want to get on with some stuff. So what do you want to get on with? Because I would say the question, well, why wouldn't you wait? Just delay the feasibility study. It'd be fine.
So for permitting reasons, to permit the underground, you'd have to do a lot more work. You'd have to do a lot more drilling, not only for exploration and converting ounces, but for water inflows, all that kind of stuff. Deep holes, very expensive work. That we could otherwise do out of cash flow and not dilute the company. It wouldn't be a good strategy to do just the open pit portion if we had less than 8 years of open pit mine life, because then that's hard to finance. but we have well in excess of 10 years of open pit mine life at full capacity. So that allows us to go out and finance and build a mine and then use cash flow to move on to something that doesn't come into play into year 6 anyway. So we're not diluting shareholders. We're saving a lot of money. We're not delaying permitting by several years to drill off something, and then who knows how much more difficult it becomes to permit. So we get a mine going, we create cash flow, and then we do a phase 2 feasibility. So we will see a net present value that is lower than the PEA simply because we're only doing one portion of that value up front. And then we're going to add value at lesser dilution to the company by doing the phase 2 feasibility, which adds the other.
So nothing's gone away. You haven't lost ounces. You've just deferred the process that you're going to go through there so you can start doing other stuff like environmental and permits and licenses, et cetera, to allow you to get the financing. Is that what you're saying?
That's exactly it.
Right.
Yeah.
Okay. So
it's like if you were a real estate agent and you wanted to start renting out houses, you'd buy what you can with your money. And as the rent comes in and pays for those houses and there's a little bit extra, then you add to it and you can add to it and add to it. And then you have all these homes that didn't cost you up front.
Okay. I just want to be clear because we will have questions come in and we have already. It's like, so you're not hiding anything. You haven't lost anything. This is a conscious decision of yours to get the economics going sooner so you don't dilute by raising at these rates, because I think most precious metal companies
protects and advances everything for all of our stakeholders.
So actually, while we're on the topic, last time we spoke, you're about 90 cents. You're about 60 cents now. What's going on?
Well, I think if you look at put us up against our peers and you look at comparables, it's happening to everybody. It's the market, but I'm of the view that I think a lot of people are in this industry, and maybe I'm just too used to being with gold bugs, but the timing for our project is fantastic because I think we are in the final cycles of a gold bull run that will last several years. Starting next year, I think we'll start seeing the gold value go up. Right now, gold doesn't know which direction it wants to go. It's struggling at a certain top, and it's not going through a certain bottom. So it's range bound at the moment. And I think all indicators that make gold move are happening across the globe.
So what's happening with your warrants? I mean, how many have you got outstanding? Is that going to cause
any pressure later on? We have 0 warrants. So we actually exercised all of our warrants. We found buyers for any sales into exercising those warrants. So all those shares are in good hands now. We're quite a tightly held company at the moment.
So what can we expect to see from you? Because if I look at a company like Marathon, they did a lot of promotion around their feasibility study and the way that they've gone about it. And obviously they've got a good project there and they've built it out well. How do you intend to, given you're starting in a slightly unconventional way, right? You're splitting it. It's phase A, phase B, or phase 1, phase 2, however you want to position it. And you've explained why, and it makes sense. But don't you feel under a little bit more pressure to maybe put out more information, I don't know, videos or promotions around how you're going about doing the phase A and phase B as you're doing it?
Yes, absolutely. As soon as the feasibility is done at the end of this year, we can then use that type of information to also, hone into phase 2 and what it would look like with videos and more promotional material. So, the other thing is when you get into a phase of the flat Lassonde portion of the Lassonde curve where you're building and permitting and it's boring and why would I buy your stock till it's built? Well, we're going to put a wedge in that Lassonde curve and tilt it upwards by drilling west of our project. We have 3 million ounces in 2 pits and a little bit of underground underneath them to 500 meters deep. We have 1.5 kilometers, which is actually the same strike length as our 2 pits, 1.5 kilometers further to the west. And if you follow the strike of the mineralization, it hits another past producer from the same era as Goldboro in the late 1800s, early 1900s. So they were mining the anticlinal systems to the west, the pits to the east, closing in on 3 million ounces plus. And we haven't drilled a hole, but there's a geophysical signature showing that mineralization continues. So we know there's mineralization for another 1.5 kilometers. but we have to drill test it to see if there's any ore within that mineralization.
So potentially, a long strike is one thing. Is there any old data that you can look at in terms of what that mine produced, or any data which it left behind?
Just that from the mine, yeah, we have some of the underground workers. They were mining the anticlinal systems that we found in our deposit. So it's the same trend. We just don't know what happens in between, whether it's at depth or it comes closer to surface. But the geophysical signature suggests the mineralization continues. And that's a fantastic, it's not an arm-waving exploration target. It is, if you talk about the shadow of a head frame, this is, in the shadow of a head.
So you're looking to join up the dots there, and I guess you'll explain what that drill program could look like once you've worked it out. But the drilling so far has been relatively shallow, hasn't it? I think up to 500 meters. I mean, are you planning to do any deeper holes than that?
For these types of systems, it's very shallow drilling so far. Our deepest hole is 540 meters up.
Right. Okay.
Of any hole we've ever drilled. Our resource that we're looking at in the PEA for underground mining goes down to, at the deepest spot, about 500 meters. The analogs of these types of deposits, these anticlinal deposits that look like this around the world, like Fosterville and other Victorian deposits in Australia, these go for kilometers at depth. So we have a lot of opportunity at depth. We have a kilometer, the same opportunity on the western half of our project as we have on the east, which is approaching 3 million ounces and not drilled at depth. So this, we're convinced, is going to be a multi-generational mine once built.
Okay, and just so I understand what's going on here, so you've kind of got this former producing mine. Are you seeing sort of these? Well, again, I don't know how much data you've got, but these sorts of halos of deposits elsewhere, and and how do you go about? Well, one, targeting them, exploring them, and or even quite frankly, understanding, what's there, the type of gold, how you approach it. I mean, is that sort of work that you're looking at? Yeah.
So what we're doing is we will cut line west of our current pits in order to do a ground-based IP, induced polarization survey. So that's a geophysical technique to pinpoint chargeable mineralization, which would be the host arsenopyrites and pyrites that are associated with the gold. And what it will do is pinpoint exactly where the noses of these anticlinal systems come close to surface. That's where we know we can drill from the north to the south and from the south to the north to hit the limbs of these, and continue just moving from the known through the unknown back into the known again of the past producer, and see where within there other pits may be lying of similar type mineralization, or actually the same type of mineralization, but similar size to what we found in the east. I mean, we could be talking about quite a few million ounces here over time.
I'm gonna jump over to Stoggertype because you put out a press release. It's getting funny now. It's now still got another 2 to 3 years of life of mine, which it has done for the last 10 years. So that's good news because it's throwing off cash, which is, well, one, I guess talk about that, but I want to talk about what you're doing with the cash in terms of the drill program in a second. So Stoggertype, give us the update.
Yeah, so in Newfoundland, where we have our operation and generate cash flow, we're currently mining a deposit called Argyle, which we had some startup issues with, but now mining well. We've caught up on the waste development, which is the expensive stuff that doesn't produce ore, over a few quarters, and now we're right into Argyle, and things are going well. And that's got another 14 months of mine life. Right. But we've discovered another project, another mineralization area called Stoggertype, and we just put out not long ago our resource on that, which is quite incredible because it's 70,000 ounces, and we only produce 20,000 ounces a year. So, this.
All right, it's even more.
It's 642,000 tons at 3 grams per ton. So we're currently mining just under 2. So it's higher grade. It's closer to the mill, and it looks like that 60,000 ounces of mineralization in resource at Stoggertype should translate to at least half of that, 50 to 60% of that, of mineable ounces at a little over 2 grams, 2.1 or 2.2 grams per ton. And that'll be another 1.5 to 2 years onto the. So now you're at 2 to 3 years again, which we've been at for a long time. But discovering Stoggertite, which is a little different mineralization than we've mined in the past in Newfoundland, has opened up a whole bunch of other targets. We have at least 4 quality targets that are lookalikes to Stoggertite based on geochemistry and geophysics that we're now drilling as well, like Corkscrew and Big Bear and Pumbly Point and Deer Cove, which we mentioned in our press releases as well. So stay tuned for maybe other discoveries. What we'd like to always have is one mine being in production, one mine being developed to follow it, and another mine being drilled off as a new discovery. And looks like that's what we're heading to in Newfoundland.
Okay, so potentially another 10 years of 2 to 3 years life of mine.
Well, I don't think we'll ever show 10 years on the books, but I think we'll show 2 to 3 years for the next 10 years.
That's what I thought. Well, okay, so let's get on to the cash component of that. So that is throwing off cash for you guys. What's the free cash flow from those operations which allow you to reinvest into Goldboro? Because that's the kind of flagship,
so at
right?
$2,000 Canadian gold, which is about $15.50 US, quite a reasonable long-term gold price for us. I think we're going to have to start looking at jacking that up to $1,600, because that's what's basically out there now, $1,600 to $1,650 for long-term gold prices. That gives us, for next year, which will be looking like a record year for us, should give us over $20 million free cash.
Right.
The next year after that, if Stoggertite comes on stream, again, it's a similar style deposit, similar size, a little bit higher grade and a little closer to the mine site. It should do even better than that. So we're looking at 20 million plus for the next each year for the next 2 to 3 years, which obviously will not build Goldboro, but allows us to move it forward with feasibility and have some kind of leverage when we're talking about project finance as well.
Well, exactly. Again, that's where I want to go. Before we do, total cash position at the moment, given this money is
about $8 million. We have about $8 million in the bank. The other thing about generating cash flow, we actually don't use that generated cash flow very much on exploration, because our projects are in Canada and we have what's called flow through here, whereby we can raise funds at approximately a 30 to 35% premium to our current share price to use on exploration only. And that's the qualification. You must use it on exploration in Canada. So we actually use that charity flow through to raise funds to do our exploration. So everything we do is looking at dilution to the company, because we don't want to dilute any of our shareholders or stakeholders, which include us.
Right. Okay. So let's try and get some numbers out of you that people will understand in terms of this exploration program and what you at Goldboro and what you're trying to do there. If we can focus on that, is so how many meters, how much money, how much time, and to what end? Is everything going to feed into the feasibility study, or is there going to also be additional exploration?
Oh no. There's much more. We're going to embark on a 20,000 meter drill program west of the what I just described earlier, west of the pits. It's a $4.5 million program. It includes a 50 line kilometer IP survey on the ground, and that'll all be with flow through funds, separate from all the work that we're doing, including a lot of drilling at site. We're drilling in between the pits. We're infill drilling some of the inferred that surround the circumference of some of the pits, so that they may even grow in size, the current pits that we have. We're also doing a lot of geotechnical holes, a lot of water well drilling, to all the work we need to do to finalize the feasibility and to understand the water inflows into the pit, do the final numbers for getting the feasibility done in mid-December.
Right. Okay. So again, you seem quite keen to talk this anti-dilutionary language here, right? Well, I guess as you should do. Are you feeling a little bit super sensitive about the people's perception of what the feasibility situation is? Is that you're trying to make it clear that you're not trying to dilute people? You don't want to raise money.
Right. I mean, hence the reason we're doing a two-phase approach. One of the many reasons why it wouldn't be a good use of proceeds right now to spend money on drilling deeper than 500 meters, and including and infill drilling all the inferred deep ounces to include in a feasibility whereby those deep ounces don't come into play until year 6. Why not open up the mine and get cash flow going to drill it off from maybe even a drift off one of the pits to not have long, deep drill holes and use cash flow. That's much less dilutive to the company. And quite honestly, opening up a mine for several years of open pit obviously gives us that view of the deposit in 3D for years before we design an underground based on that.
There's rumors that you've had another company walking around some of your projects. Is there anything to those rumors, and why would another company be walking around a couple of your projects?
Well, I think there's always rumors in this industry, as you'll see, as everybody knows, and we have we do mine visits all the time. We always look. We work closely with Maritime Resources and Rambler on synergies in the area, especially with Rambler. If we have issues on getting, supply chain right now is difficult worldwide. If we have issues getting some components for our mill, we'll call up Rambler. And likewise, the other way around, when they need a hand from us, we'll help them. There's times where people visit. I've visited every project in the area. Why wouldn't I? I need to understand things more. So that happens time to time, but I don't know what those rumors are about or what they refer to. But we have people at site all the time. We're open to showing it to everybody.
Right. So, but there's no M&A in the offing here.
Well, if there were, I wouldn't be able to talk about it because it'd be under CA. But I can tell you that we keep operating. We love our project in Newfoundland, and from time to time there are people that visit site.
Okay, we will leave that there. So what would you say your big message is here? You said from day one, Goldboro's the thing that you are most excited about. Do you think, and you also said earlier, you think you've timed it right? And tell me what you mean by that. Because obviously the market sucked for the last 12 months. So why have you timed it right?
I don't think that, I don't believe that we've timed it right. I believe that the timing is working out for us. We are trying to get this going as quickly as we can and doing all the permitting we need to do to get it going, which is the bottleneck here. And it's setting itself up that putting a feasibility out at the end of this year, going into next year, and then talking about project financing for at least another year, because that permitting will take at least another year. I think we'll be well into one of these legs of this gold bull run. And I'm not talking about crazy numbers of gold like 5,000 or 4,000, but boy, oh boy, somewhere in the high teens or 2,000, US, this thing would be through $1 billion NPV. At those types of numbers. So you're looking at an environment that potentially has an increasing gold price. You're looking at a project that's in a first world and easily financeable for a company our size. And you're looking at it being the next one to be built in Nova Scotia and the largest gold deposit in the province and the highest grade undeveloped open pit on the East Coast. All those things tick a lot of people's boxes. And I think we're, like I say, we're tightly held. So in a dull environment, or when it's not a bull market in gold, you don't have much trading. But when you do hit a bull market and people want to buy, there's not much supply, and that's when stocks will start moving quite rapidly. In my view.
Do you think that your Newfoundland projects could do better sitting in another vehicle? We've seen a lot of promote around Newfoundland projects, right, from various parties. Some projects more. Well, better than others, let's put it that way, but all getting an equal amount of love. Have you considered that in the last year, given what you've sort of seen in the market?
Yeah, I mean, we've since I started with this company, we've always been looking at it like what's best for shareholders, and it is possible that either in a spin out or in a separate vehicle might be better overall. So we're always looking at opportunity and things that will be create shareholder value on an ongoing basis. So we do think about it. We think about it quite often. And but remember, flavors of the month change quite quickly sometimes. So I think you'll see, with the things that are going on in Nova Scotia too, I think you'll see more investment going into Nova Scotia, and then somewhere else will pop up in the world. It's quite exciting, and things change. So what we focus on is doing something meaningful for our stakeholders that create shareholder value and grow the company.
Based on fundamentals. How old school of you? Right, let's.
Did you just call me old?
I know. No. I think it's old school mentality of focusing on making money properly based on fundamentals, I think is a very, very good thing. So just on the environmental component again, I want to make sure I understand this. It's like if you go ahead with the feasibility phase A, phase B, you can kind of get on with that process today. That's a big driver for you, because is it taking longer these days with ESG as the number one topic for funds, for investors? Is it taking longer to get over the line?
Yeah, and I think it's a simple fact that there's more work to do to prove that you're not going to harm the environment any more than you need to, and that you're not going to create any social issues any more than you need to. And getting that down and on paper and understanding the project and defining it specifically to the government of the province you're in or the area you're in the world is very, very important. So for us, we could put in our environmental assessment registration document today, but it wouldn't be complete. And that doesn't fast track things. That actually does the opposite. So we're going to finish our feasibility. We're going to spend another 6 to 8 weeks after that putting our EARD together. And we want to be known for the company that put in the most comprehensive, detailed EARD in Nova Scotia history for gold mining, so that the question and answer and review periods are minimized. You can have anywhere from 1 to 4 of them, and they are 3 months each of review, further questions, review, further questions. You can have 4 of those. We're guiding that we will have 4 of those because it's a large project. But the better we do up front with our EARD, the less questions we'll get and the less time it'll take to finalize to get final permits.
Right. So just, again, timing on the feasibility is what? What's the date we're looking for?
Mid-December.
Mid-December, so pretty soon.
So that means by the end of February, we should have an EARD delivered to the government, which defines and sets the project as an open pit project and exactly what you're going to do and where the infrastructure is going to be and the discharge into the environment. And then they start working on whether they have questions, they want further information, and there's 4 periods of that. We're guiding that we'll take all 4 periods, which is 18 months.
Right. Okay.
Till we're shovel ready.
Okay. So you shovel
from the end of February.
Okay. So now I've had a company again on this week, and they've gone from PEA to feasibility study, and then they're getting funded. That seems to be the model that you're suggesting, and that you can employ here. So,
well, ours, just to be clear, ours is a little different, Matt. We haven't gone from PEA to feasibility. We started the feasibility 2 years ago. We did a PEA because we had such an upgrade in resources at one point, and more specifically, over 1,000% increase in open pitable resources, that we had to somehow define the change in scope from a small underground high-grade mine to a large open pit mine up front. And also to protect ourselves, because we felt very vulnerable having millions of ounces added to our company and not having any economics around it. So we chose to do the PEA in parallel. So the PEA actually had a lot of fundamentally feasibility level work on the metallurgy and things like that wouldn't otherwise be in a PEA. It would be more of an estimate. These, for instance, the recovery in the PEA is feasibility level metallurgical work. Okay. So that will change.
Okay, understood. So you're going once you get the environment. Are you already having conversations with regards to with funders about getting this funded? Because they'll have those conversations subject to you getting the environmental, et cetera, in place, right? So what do you know today?
Correct. We have had over 60 meetings with project finance groups, from streaming and royalty companies to debt providers to banks, everybody, and they're all pretty consistent with what they're saying, which is this is a robust project based on the PEA so far, in a good jurisdiction, a great jurisdiction, and it's easily fundable to up to 60 to 70% debt if required. So those groups are ready to put term sheets in front of you, obviously with conditional on permitting and other things, but they're ready to do that. We're not ready to do that until our feasibility is done and we're talking about actual concrete numbers.
Absolutely. So have you had conversations with them since you decided to do the feasibility study like this? Because financing a project of scale and big CapEx, that's going to be attractive to some, and where if it becomes a little bit smaller, it may not be as attractive to them because the monies required are smaller, right? So what's the dynamic of that conversation? Do they understand why you've chosen to do it this way? And has anyone fallen away as a result?
Nobody's fallen away. As a matter of fact, most people like it. And the reason is they'll fund something that gets payback quickly within those 10 years. That's why an 8-year plus mine life is important. So to them, it's an open pit mine life with this huge upside of underground later that really doesn't play into their valuation, but they love that there's a potential long-term mine life because the underground doesn't go away. It's just simply not at feasibility level yet. So you can still look at the PEA once the feasibility for open pit's done and say, yeah, but this is to follow. And they won't be blind to that. I mean, anybody that does fund this project is going to have their own independent engineer review it and stuff like that, and they'll see the potential.
Okay. Well, look, I appreciate the update. You, sounds like things are obviously moving forward. I understand the rationale between splitting the feasibility study between open pit and underground. What did you say? Just again, I want to leave me with that thought. What's the timing on you saying, right, we'll do the underground feasibility study at what point again? So
the PEA suggests that the best time to develop underground is around year 6 from within the pits.
Got it.
And so that gives us quite a bit of time to do that second phase. But we will do it as early as we can, which means as soon as we get enough inferred drilled off out of cash flow when the open pit mine starts.
Because you've got to get that balance between the most efficient way, if it's all about efficiency, so year 6 would make sense. You have a lot of data by that point, and obviously pleasing the market in terms of scale, conversation around grade, underground, etc., and bringing the economics forward, because there will be cost to it, but you're going to be making money, so presumably you're bringing the potential forward. So how do you review that or get that balance right?
Well, what we've chosen to do is that the underground will start, and actually the $300 million to develop the underground will be completely out of cash flow that's built up over the years. So there isn't a secondary financing. Basically, you're building 2 mines for the price of 1 with cash flow. So, again, not dilutive. Okay. So, year 5 and 6, you'll see the all-in costs go up quite considerably because you're spending, I think, year 6, 62 million on underground ramp development, and then at 30 the next year to develop it all, to get it going. But then you're stoping. And the key is that underground mining at this particular deposit is only on the high-grade anticlinal lenses, whereas the open pit takes all of the halo mineralization. So the difference in grade between, even though it's confusing, the grade isn't getting higher at depth, but when you go to underground mining, you're mining only the high-grade veins within a system that's lower grade. So really, you jump up the grade by 2 to 3 times when you go underground. So really, it's not about starting it earlier and getting more capacity through the mill. It's about incorporating the undergrounding, and the grade actually goes up overall. So we started about 87,000 ounces a year on average for the first 5 years, and then we developed the underground, and then we moved to 137,000 ounces a year without any more throughput. It's just a grade difference for the next 10 in the PEA at some very low operating costs.
Kevin, good update. Stay in touch. Let us know how you get on. I'm intrigued by the new plan, and hopefully we'll get a sense of the new economics before Christmas as well.
Great. Thanks a lot, Matt. Have a great night.